Margaret sat at her kitchen table last Tuesday morning, holding a letter that made her hands shake. It was from Medicare. Her premium had jumped by over $300 a month. $300 gone every single month. She didn't understand. She had retired almost 2 years ago. Her income was lower than ever. So why was Medicare suddenly charging her more? She called her daughter crying. She thought it was a scam. She thought someone had stolen her identity. She felt her stomach drop because that $300 was her grocery money. It was her medicine money. It was the difference between paying her electric bill and sitting in the dark. But it wasn't a scam. It was the law. And Margaret had no idea that the simple choice she made 2 years ago, the month she picked to retire, had quietly set off a financial trap that would follow her for 3 full years. If you are watching this right now, and you are planning to retire soon, or you retired recently, please stop what you are doing and listen carefully, because what I am about to share with you could save you thousands of dollars. I am Masha. I am a Senior Policy Analyst, and I have spent years helping retirees just like you understand the complicated rules that the government does not explain clearly. Today, on Pension and Law Unlocked, I am going to walk you through the exact rule that caught Margaret off guard. I will show you how the month you retire can change your taxes, your Medicare premiums, and even your Social Security check for the next 3 years. And please, stay with me until the very end. Because there is one hidden mistake almost every senior makes when they retire, a mistake so small that it slips right past them. But that one mistake can cost you tens of thousands of dollars in penalties, surcharges, and lost benefits. I will reveal it near the end of this video. So pour yourself a cup of coffee, get comfortable, and let me tell you a story. Robert was 67 years old. He worked his whole life as a maintenance supervisor. He was proud, hardworking, careful with money. He raised 3 children. He paid off his house. He did everything right. Robert decided he wanted to retire in November. Why November? Because he wanted to enjoy the holidays without having to wake up at 5 in the morning. He wanted to sit by the Christmas tree with his grandchildren. He wanted to drink coffee in his pajamas. That was his dream. So Robert filed his retirement paperwork. He started his Social Security benefits in December. He took a small lump sum from his 401k to fix the roof. He felt happy. He felt free. Then April came. Robert sat down to do his taxes, and his jaw dropped. He owed the IRS over $11,000. How was that possible? He thought retirement meant his income would go down. He thought he would pay less in taxes, not more. But what Robert didn't know is that he had stacked 11 months of full wages on top of his Social Security, on top of his pension, and on top of that 401k withdrawal. All of that income landed on one single tax return. But it gets worse. The next year, Robert got a letter from the IRS. He owed an underpayment penalty. Why? Because while he was working, his employer was automatically withholding taxes from his paycheck. But once he retired, nobody was withholding enough from his pension or his Social Security. The IRS expects you to keep paying as you go. Robert didn't know that. So he got hit with a penalty on top of the taxes he already owed. And then, in the 3rd year, just like Margaret, Robert got that dreaded Medicare letter. His Part B premium had jumped. His Part D premium had jumped. Hundreds of dollars a month, all because of that one big tax return from the year he retired. 3 years of pain. From one decision. The month he chose to retire. This is what the experts call the 3-year tax trap, and almost no one warns seniors about it. Let me explain this in plain English, because the government documents make it sound much more complicated than it really is. When you retire, 3 things happen at the same time, and they crash into each other like 3 trains at one intersection. The first train is your wages. If you retire in October, November, or December, you have already earned 8, 9, 10, or 11 months of full salary that year. That money is taxable. There is no escaping it. The second train is your new retirement income. the day you start collecting Social Security, the day your pension begins, the day you pull money from your 401k, all of that becomes taxable income too. And here is what most seniors do not realize. According to the IRS and the Social Security Administration, up to 85% of your Social Security benefits can become taxable if your combined income goes over $34,000 as a single person or $44,000 as a married couple. And those numbers were set back in 1983. They have never been adjusted for inflation. Not once. So almost every retiree today crosses those lines. The third train is the Medicare look back. This is the one that hurts the most, because it shows up 2 years later, when you have completely forgotten about it. Here is how it works. The Social Security Administration looks at your tax return from 2 years ago to decide what your Medicare premium will be today. So if your tax return from your retirement year shows a high income because of all those wages plus your new retirement money, then 2 years later, Medicare will charge you a higher premium. They call this IRMAA, the Income-Related Monthly Adjustment Amount. And IRMAA is brutal. It can add an extra $70 a month at the lowest level. At the highest level, it can add over $400 a month. And if you are married, both you and your spouse pay it separately. That money comes straight out of your Social Security check before you even see it. Now, there is one more thing I want you to understand. There is a special rule that the Social Security Administration has, called the First Year of Retirement Rule. It says that if you retire in the middle of the year, you can still get a full Social Security check for any month you are considered retired, even if you earned a lot of money earlier that year. For 2025, that monthly limit is $1,950 if you are under full retirement age. But here is where seniors get confused. This rule only applies to your Social Security check. It does not change your taxes. The wages you already earned are still fully taxable. So please do not mix these two rules up. Now, I do not want you to feel hopeless, because the good news is, the government has actually built protections into the system. They are just buried in paperwork and nobody tells you about them. So let me give you 3 exact actions you can take, starting today, to protect yourself from the 3-year tax trap. Step 1. File Form W-4P with your pension administrator and Form W-4V with the Social Security Administration. These 2 forms are your shield. Form W-4P tells your pension how much federal tax to withhold from each payment. Form W-4V lets you choose to have 7, 10, 12, or 22% withheld directly from your Social Security check. If you do not file these forms, the default withholding is often too low, and you will end up with a tax bill and a penalty. Filling these out takes 10 minutes. It can save you thousands. Step 2. If you are already retired and you got hit with a high Medicare premium, file Form SSA-44 immediately. This form is officially called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. The Social Security Administration recognizes work stoppage, that is, retirement, as a qualifying life-changing event. If you file this form with proof of your retirement, like a letter from your employer, the SSA can recalculate your Medicare premium using your current lower income instead of that inflated retirement year tax return. This one form has saved retirees thousands of dollars, but you have to file it. They will not do it automatically. Step 3. Plan your retirement month carefully and consider a direct rollover instead of a lump sum. If you have any choice in the matter, retiring in January or early in the year can dramatically reduce your year 1 tax burden because you will have very few months of wages on that return. And if you are moving money out of a 401k, do a direct trustee-to-trustee rollover into an IRA. That way, the IRS does not take a mandatory 20% withholding from your money, and you do not inflate your income for that 2-year Medicare look-back. Now, before I tell you the hidden mistake, I also want to mention something called the Safe Harbor Rule. The IRS has a rule that says, if you pay in at least 100% of last year's tax bill through withholding, they will not charge you an underpayment penalty, even if you owe more this year. So that is another tool in your toolbox. Pay attention to it, especially in your first retirement year. Now, here is the hidden mistake I promised to share with you. Almost every retiree thinks that once they file their taxes and pay what they owe, the problem is over. They breathe a sigh of relief. They think, well, that hurt, but at least it is behind me. But it is not behind you, because IRMAA is still coming. And here is the mistake. When that Medicare premium increase letter shows up 2 years later, most seniors just accept it. They think, well, that is the law, there is nothing I can do. They pay the higher premium for an entire year, sometimes for 2 years. They lose thousands of dollars. But the truth is, you can fight it. You can file Form SSA 44. You can prove your income has dropped. You can ask the Social Security Administration to use your current income instead of that old tax return. And in most cases, if you have documentation, they will adjust it. But, and this is critical, the Social Security Administration will not refund you for months you already paid at the higher rate. So if you wait 6 months, 8 months, a year to file the appeal, that money is gone forever. You have to act fast. That is the hidden mistake. Waiting. Assuming you have no power. Assuming the government will fix it on its own. They will not. You have to be the one who acts. So please, my friend, do not rely only on YouTube to keep you informed. YouTube does not always show you my videos when these rules change. The notification bell is not enough. Things change too quickly, and the government does not send out warnings. That is why I want you to click the link in the description below this video and join the Global Senior Alerts official WhatsApp channel. When you join, you will be able to download the free Senior Benefits Protection Guide, which walks you through every form, every deadline, and every rule we discussed today, in plain language you can actually understand. You will also get real-time alerts on Social Security changes, pension updates, banking rules, insurance policy shifts, and travel regulations that affect seniors. It is completely free. It takes less than 30 seconds to join, and it could save you thousands of dollars and hours of stress. Margaret wishes she had known these rules 2 years ago. Robert wishes he had picked a different month to retire. You still have time. Use it. Click the link. Join the channel, download the guide, and share this video with someone you love who is about to retire, because they need to hear this before they make a decision they cannot undo. This is Masha, from Pension and Law Unlocked. Thank you for trusting me with your time today. Take care of yourself, protect your benefits, and I will see you in the next video.